Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Excuse me. I'm actually in the studio this morning, so if you have a call, you can call us 216-901-0945. That number again, 216-901-0945. And if you would, if you hear something you'd like more information about, you can always go to my website. It's bullingtoncapital.com. And when you get there, if you go on and you click on the button where it's or the word contact, it'll bring you to a contact form. First of all, it shows you a map. It'll show you where we are. And then there's a contact form. You put your name, put your email, and put a message in there. Now, by the way, I get people signing up for my newsletter quite often by putting their name and email there, and that's fine. You'll automatically be added to my newsletter list if you want to see that. But if you have a question, you just need to fill in that block where the question is, if you can. Now, if you can't, I mean, if you're not that comfortable with computers or the internet, I know there are a lot of people out there that still aren't, so don't feel bad about that. My phone number is 330-664-0700. That number again is 330-664-0700, and you can always give us a call, and I'll be glad to try to call you back as quickly as I possibly can. And I've been having to call a lot of people back, as you can imagine, with the stock market is down as much as it is this year. It's pretty rough. But you know what? The entire time I've been in the industry, it's always been like that. I mean, markets have been incredibly volatile, and it's really not that unusual. It really isn't. And I know a lot of people struggle with this. A lot of people struggle because the market is so volatile. They want to see, they see the long-term returns. They hear about the long-term returns, and they want that very badly. But when they get into the market and then they realize how volatile it's been, and that's the price that you pay to achieve those long-term returns, some folks change their minds. And or they do what a whole lot of people do and they try to get a feeling or try to time that up. Well, you know, if it were that easy, I'm telling you, if you could accurately predict one or two 10% moves in the stock market, one or two, I can show you how to make an enormous amount of money, and you won't have to work again. So it's not a trick. Okay, there are these things called futures funds, or just futures. There are some funds that have futures in them, but so S&P futures, NASDAQ futures, basically you put, I think it's about 5% down if you're a day trader. So, you know, and you can take a relatively small amount of money. You're borrowing literally 20 times the amount that you put down. Okay, so that's going to move 20 times greater than the index is, roughly. So if you were going to if you wanted to make a lot of money in that, what you do is you'd buy an option, a put or a call on the futures contract. And when it moves, now you've multiplied the moves, probably 1,000% or so. So, long story short, if it were that easy, there would be billionaires everywhere. And the fact that most people aren't billionaires, and the fact that most of the people that are online are still showing up to work at CNBC, that just shows you how hard that is. Can you get lucky? Yeah, you can get lucky, but it's going to be luck. And if you keep trying that, if you keep pushing that, eventually it's going to push back. So I don't really like to do that, and I'll stop talking about that. Not a whole lot of people are even interested in doing something like that anymore. Thank goodness. I used to get, the only reason I'm talking about it is occasionally I'll get a phone call from somebody who read something somewhere on the internet, and because it's on the internet, it's got to be true, right? Okay. So, and I have to spend a lot of time talking and explaining why what they want to do is literally not possible. There are possibilities, okay? And there are possibilities that the Browns will go undefeated 3 years in a row. That's a possibility. I wouldn't want to put my retirement on that. So I don't want to put any money on that. I mean, and that's the likelihood of you making a tremendous amount of money from some of these strategies. It's about it. And actually, now I have a better chance of running a sub 4-minute mile than you will of making a lot of money trading options. Now, in my best days, that was never going to happen. But I mean, I could run 1 or 2 quarter miles under 60 seconds, and that was kind of moving for, I think the last time I ran in track was in 8th grade. Yeah, I pole vaulted. But yeah, there's a reason I pole vaulted instead of running the mile or the quarter mile. That's a sprint, by the way. That's not a long distance run. You are sprinting the entire time. And anyway, the chances of me running 4 of those under 60 seconds in a row at my age now are better than the chances of you picking out an out of the money option that's going to make you rich in a week or two. Okay, so hate to be the bearer of bad news, and it's not really bad news. Man, the market being down as much as it is, I was a little depressed a few months ago because I'm looking at the market and going, wow, this is there's no room. I mean, when they say price perfect, I'll get this out. Price for perfection. That's what they're talking about. They're talking about stocks that are slightly ahead of themselves. And as a general rule, when you look at the Dow or you look at the S&P 500 and you look at the NASDAQ, QQQs, you look at the valuations on those things, like, wow, they're really ahead of where they should be right now. And that's not all that desirable. I mean, you'd really like to have something that's selling lower than it should be. And I'm not saying they're lower than they should be now. I mean, if the economy continues to struggle, if supply chains don't open up, if something happens in Europe, they're probably going to go lower. Won't be the end of the world. But this is one of the reasons that you always want to have some of your money in bonds. And I don't care how old you are. You want to have some of your money in bonds. And a caller comes to mind. As soon as I say that, I'm probably going to get an email on my way home. Says he doesn't need any of his money in bonds ever. And I'm like, that's great. He's got a $20 million net worth. Yeah, you wouldn't have to put your money in bonds at all. You could just live off the dividends off of a handful of ETFs and fly, brother, be free. Your worrying days have been over a long time ago. That's not the situation most people find themselves in. And here's another thing. I mean, I hear so much stuff on, well, you got to do this. You got to think about this. You got to think about that. There are lots of things to think about. Let me tell you what you really should concentrate on. There's this rule. It's called the 4% rule. You typically don't want to have to start off spending more than 4% of whatever your savings is. So whatever your retirement date is, let's say it's 65, or let's say, 65. Take 4% of your savings, add it. Well, you're not eligible for full Social Security at that point in time. So let's say 67. 67, you get full Social Security. Okay, you're going to take full Social Security, and that's going to give you, I don't know, just off the top of my head, just say $30,000 just to make it easy. Okay, so $30,000, but you need $70,000 to be able to live the lifestyle that you're living now without having to cut back too much. That's pretty reasonable. So that $40,000 that you're going to need to generate from your investments. Now, with the 4% rule, you take the $40,000 divided by 4%. That's $1 million. Okay, so you need $1 million to generate that $40,000 a year to supplement your Social Security and get you where you need to be. And that's as complicated as the retirement planning really needs to be. That's it. Everything else is, what are you going to spend? What are you going to spend on your housing? What are you going to spend on cars? What are you going to spend on medical care? If you're like most people, you either have medical insurance if you're a government employee that you'll be paying some of. You'll get a supplement policy, and then you'll pay for that. And that's one of the bigger ones in retirement. I'll come back to that one on a later show. But essentially what I'm saying is just put a budget together. How much money does it take for you to be able to live in the lifestyle that you're living now? How much is that? And you know what? I think I have a phone call. I'm going to go ahead and should I take that or? Yeah. If you'd like to call in, number is 216-901-0945. 216-901-0945. And so we're just talking about the 4% rule and how that works. By the way, the reason that you're only going to withdraw 4% if you've got a traditional portfolio is that you're going to have to increase that over time. It's going to have to go up. And 4% is typically the rate that's recommended by most financial professionals, that you kind of shoot for that. If you have to go a lot over that, and you may want to consider cutting back in your lifestyle, we'll get to some of that stuff later, and I'm going to go right to the phones now. And I've got Jason. Jason, you're on the Bullington Capital Report.
Yeah, good morning. Hey, Bill, with interest rates headed up, what do you think of brokered CDs as an investment option in today's market?
I've been using a lot of them, and I think they're a really good idea. So if you've got access to it, or just call your local financial advisor. Those are not CDs that you would get, by the way, from a traditional bank. Brokered CDs, you go through brokerage firms, and that's why they call them brokered CDs. They buy and sell CDs a lot like they buy and sell treasury bonds or corporate bonds now. And I really like it. The interest rates have crept up quite a bit. You can get a pretty decent rate of return. I think over 2 years, it's around 4% or so, and might be a little bit higher than that. If you're in a brokerage account, if it's going to be managed, there's going to be fees involved with that. If it's not, if you're doing it yourself, then you get to keep 100% of the income that you're generating. But yeah, I think it's a good idea. It's something that's something you should look at.
And those are marketable too, meaning you can trade them if you want to get out early.
You can. The price is going to fluctuate a little bit. So you don't. If you're buying really long-term brokered CDs, the price could drop a lot. You probably don't want to do that, and that's not that often that they have them anyway. But you just want to be careful when you're buying something that's got a 10-year or more maturity, or 5-year even more maturity. The price on it can go down, and in that case, you'd probably want to wait until either the price moves back up or it just matured, and then you wouldn't have to lose any money on that. Now, you do get the interest that accrues for every day that you've held it, so oftentimes that can offset something if it's down just a little bit. An income that you get can make some of that back. So those are all questions you want to really talk to a financial advisor about. that's not a product that it sounds pretty simple, and there's a whole bunch behind the scenes that you should probably know before you jump in, because more often than not, when you're learning something after you've purchased it, it's generally not a positive surprise. It can be a real negative surprise, but then again,
how come the brokered CDs pay more than what's the CDs that the banks offer directly?
There are all kinds of reasons for that. I mean, there's not just a single reason. The biggest reason that I know of is a lot of the times the brokerage firms are willing to buy those to take them off the hands of the bank that issued them, so that they can free up that money and go out and make a new loan where the interest rate's going to be higher. So that's a really good, and that's only occasionally. I mean, there are lots of other reasons, but that's the biggest one.
Okay, very good. All right, Bill, thanks for the info, and great show.
Thanks, I appreciate it. And wow, this is another Jason. Jason, you're on the Bullington Capital Report.
Yeah, I just wanted to touch base on what the caller just said before. I think, and you can tell me, Bill, if I'm wrong, but when I was looking at short-term bonds or CDs, what I saw the best rate right now for the risk was, 6-month treasuries right now. They're paying about 4%, the same thing as your brokered CD for 2 years. Mm-hmm. I believe that brokered CD, 2 years, that's like 2% a year, right? So it's 4%.
No, it's 4% a year. They're just
per
like,
year.
Yeah, they're just like a short-term treasury.
Okay. Well, and the 1-year treasury could get you 4%, but I guess my point is that the short-term treasury is more liquid, right? I mean, if you had a sell, if the person's worried about maybe having to break it before maturity, right. Yeah. You would want the treasury, wouldn't you?
Yeah, I would. It's a lot of the CDs are super liquid, especially the ones that are that short in maturity. So it's not really all that hard to sell them and get without taking a loss on it. But treasuries are the most liquid in the world, So, but I think they're very close. But you're right about that. I got to take a real quick commercial break. Did you want to hang on?
No, you know what? I got to go too. Thanks for taking my call, Bill.
Well, no problem. Yep. Have a good day. Yep, we're getting ready to take off to a commercial break here. Listen, if you'd like to call 216-901-0945, and I'll be back after these messages. Well, back again. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you guys have any questions for me that you can't get to during the show, by the way, the phone number here is 216-901-0945. That's 216-901-0945. Feel free to reach out to me in my office. That number is 330-664-0700. That's 330-664-0700. And I will be glad to try to answer any questions that you have and try to get back to you as quickly as I can. And, we were talking about a lot of different things. And that's one of the things I like about financial markets. It's typically never boring. I mean, it's almost never boring. Having said that, it's a lot like a roller coaster. Sometimes it's kind of boring on your way up, and then other times, you're freaking out. So this is why I have a job primarily. And they've created so many products. Oh, my Lord. Looking through the available products is mind-boggling. You can't do it without software that's relatively expensive because you want to hone in on certain things. There are certain things that will have a tendency to be more important over long time periods than others. It takes a while to figure out what that is. And I can tell you quickly, if you're looking for funds, and this is kind of what we do, we look for the funds that have good risk-adjusted returns. They're in the top 20% of their category. And one of the mistakes I see a lot of new investors making is trying to get the top one, or I want mine in the top 1%. Well, that number's going to change. The one that was top over the last 12 months, probably not going to be the top one over the next 12 months. In fact, it may have gotten lucky, and that's one of the things that you see a lot when you're looking at the 1-year performance. The 1-year performance will lift the 3, 5, and 10-year performances if it's big enough, and it can be extremely misleading. And that's one of the reasons why I see a fund that's up like that. I'll look into why it's moving, how it's moving, what are the valuations on the stocks in that fund, what's going on there. Now, sometimes there's a really good reason, and sometimes not so much. Sometimes the reasons are that people are extremely optimistic about that sector, or that the stocks that make up the biggest portion of that fund, and those stocks are extremely overvalued. Now, when they come back down, it's going to lose its ranking in the top, whatever percentage of the funds that it was in. Sometimes they drop down to 40 or 50%. And it's really frustrating. I mean, it's horribly frustrating because everybody has a tendency to want to look into the past and project that into the future. And by the way, I mean, if you didn't know any better, what else would you know? That seems to make common sense until you've been using it for a while. And then you go through 5 or 10 years and you go, hey, wait a minute, this is not turning out anything like I thought it was going to turn out like. Yeah. And by the way, having done it the right way, having held on to other asset classes who weren't outperforming at the time makes you feel bad because they're not performing as well as the best performers. But eventually, if they are a significant portion of the economy, they'll have their day. When their day comes, you'll be glad that you held in and stuck to your rules. And it's to me, it's still fascinating after all these years that it's still happening very similarly to the way it's happened in the past. Instead of using individual stocks, though, there are funds that will specialize in just about anything you can possibly think of. And so I think that that's been a big help. The problem is there are thousands of them. There are literally thousands of funds, and you have to read each one of their prospectuses if you want to know exactly what they're doing. And I think Warren Buffett, somebody asked Warren Buffett what his secret was, and he said he read a lot, and he read every company that had been followed in, I forget which one of the services that was popular at the time. Anyway, it had like 10,000 stocks in it that they were covering, and they go, "You mean you think we should read them all?" And he said, "Absolutely." And is there any other thing that you'd like to add? Yeah, I'd probably get started. He didn't say it exactly like that. I'm paraphrasing, but that's basically what he said. And I think, wow, it is true, actually. The reason that stocks go up over time is because they find ways of increasing their sales and maintaining their profit margin. That's the reason stocks grow in value. Think about that for a second. That should be common sense. It's just that I've never heard another person talk about it in that fashion out of my entire career. I'm somebody who is famous, I should say. I hear a lot of people who aren't all that famous. And you know what? It's probably because it's not that popular. So the people that are successful, super successful, and there's always an element of luck to everybody's careers. Anybody that ended up working for a big mutual fund complex, got good training, put in some good numbers, had a lot of good years, they'll tell you the same thing. They'll tell you the exact same thing. It comes down to sales and profit margins most of the time. Occasionally, you'll have companies that have some sort of an asset that's actually worth more than the company is. So occasionally that happens. And that used to happen a lot more frequently up until there were more funds than there are stocks. And in fact, there are somewhere around, it's more than 5 times the amount of funds than there are stocks for them to invest in. And that makes it a lot more challenging. And that's a lot more challenging because you've got movement oftentimes, and there's just no explanation for the movement. And it's just because one fund is repositioning itself that might be fairly large. And that's the only reason that the stocks in that fund are moving that day. It's because there's a fund out there that needs to rebalance their portfolio, and the stocks that you own happen to be in that fund, and it's going to move. That's one of the more challenging issues, I think, that people face today. And everybody wants it to be super simple. Well, it's not super simple. It can be simplified, like which is what I'm trying to do right now, is concentrate on sales and profit margins. And when you're looking at economic reports, don't be looking at what the Fed is doing right now. The Fed is looking to stocks. They look at that as a leading economic indicator. And they're using that, and their formulas are incredibly complicated. But they're going to make changes, and the changes that they're making are typically after something's already happened, trying to affect the future. And that's not an easy job. I do not envy anybody that works for the Fed. It's incredibly difficult. There's people are typically not real happy with them. They can cause major dislocations in financial markets if they're not careful. Oftentimes it's necessary for them to come in. Like Powell today feels like it's necessary to raise interest rates. We're going through short-term pain for a better future. Is that going to really work that way? I'm not sure. Neither is he. But that's that's the path we're going down. So we've been down this one before. I'm sure it's going to happen again. But now that I said that, I've got to take another phone call. And I've got Al. Al, hey, you're on the Bullington Capital Report.
Hey, top of the morning, Bill.
How are you?
Great.
That's
I
good.
asked, I guess, a follow-up question on your CD questions previously.
Yeah.
Excuse me. But does on annuities, does that interest rate follow the Fed rates pretty much also?
Interest rates on annuities are basically fixed. And
But don't they go up over time with the interest rate?
Only some of them. The vast majority of them do not, actually. And that's one of the reasons when you see an interest rate in annuities, like right now, the interest rates are like 2.5-3% higher than Treasury rates are. They've also got an investment component in there. The chances of the investment component, in my opinion, I would stick with the guaranteed portions. But they're still not as high as those have been over the past 2 to 3 years. New ones coming out at some point in time will probably start to creep up too.
Yeah, you would think they'd have to.
Yeah, they will.
But they don't follow as fast as like CDs and stuff like that.
No.
Because I noticed when the Fed raises, like it's a day or two later, and the interest rates go up, on the CDs and stuff.
Right. Yeah. Yep. CDs are the shortest term, and they will adjust the quickest. But rates go back down again. Let's say they raise interest rates and they're successful at causing a recession, which is essentially what they're trying to do, by the way. They don't want to go too far and cause a depression, but they feel like prices are heating up too quickly and they want to cool that off. So if they get the economy to go into a mild recession, you'll see those short-term interest rates on CDs drop right back down again.
Well, I remember in the 1980s, you could get almost 10% on a CD, true?
Oh, it was a lot more than that.
I know my father-in-law was happy as could be.
Yeah, I remember that was when I first started in the industry. Back in the early 80s, you could get a money market savings account. Well, it's a money market mutual fund. A lot of people don't realize that money markets are not savings accounts. And I just said that because I have so many clients that are old, they call it that. The older, I should say. I'm old now, too. But so the money market accounts were paying 18% at one point in time.
Was there any way you could lock into that, or that was a floating rate?
No, that was a floating rate, and that was my point. Because everybody, why would I take the risk? Well, because you got a 20-year government bond over there that's paying 14, Yeah, but I'm getting 18. Yeah, but that one's guaranteed for over 20 years.
I guess that would never happen because the national debt's so high, the interest we would have to pay on it would
crush.
break us.
Yeah, yeah.
Okay, thanks a lot, Bill. Thank you.
All right, thanks. Very knowledgeable. So, the national debt, that's another thing. When you start raising the rates on these things, the national debt, interest payment's going to be the number one budget item for the federal government. And I think it was number 3 behind Social Security and the military. But at these interest rates, it should be really interesting to see what happens there, whether it tends to surpass those or not. And incidentally, we were at, I think it was about 145% debt to GDP after World War II. And when we got involved in World War II, we were in a depression. So the government printed up money because they needed to pay for all the soldiers and the tanks and the ships and the ammunition and all that stuff. And as bad a shape as the economy was in, they were borrowing money like there was no tomorrow to build up our military and go help out. And that actually, that's World War II is what ended the Depression. And I hate to say that because I know some people get upset when they hear something like that, but it's true. Actually, I could say my mom was the beginning of the end for World War II because her birthday was December 7th, 1941. Literally the day Pearl Harbor was bombed. Can you imagine having a child on the day and you read the newspaper the next day? Wow. That was probably a big surprise in many ways. But anyway, hey, everything that's happening right now has happened before. I mean, it's happened multiple times before. And this is not really that bad. I hate the fact that prices are down right now. The reason that bothers me is because it bothers my clients. My clients actually know, it's not fun watching the declines. They also know that we don't have 100% of our money in stocks because if we did, half of them would be about ready to shoot me at this point in time. But we keep a lot of money in short-term bonds. We are looking at a lot of treasuries and CDs right now. If you don't have access to that, then I would look at super short-term bond funds, those that are going to lose the least amount of money when interest rates rise. And I'll give it an example. Here's a bond fund, and I keep going back to this one because somebody called to ask about this on the radio program, and they were investing in it because it had gone up quite a bit. If your only reason for buying something is that it's going up or you perceived it to be going up, that's that is a rough way to go. I'm just telling you, if you have a life expectancy of 10 years or so, you're probably going to learn a valuable lesson, and you're going to wish that you'd just listen to this show first. But I look at the 20-year Treasury bond fund, that's out there. This is a BlackRock, and it's for what it's designed for. It's great, but it's designed to give people access to 20-year or better Treasury bonds. Now, the reason that somebody would do this is actually for somebody who's super sophisticated. Okay, because if you look at where that fund peaked, was actually in March of 2020, and it peaked at $158 or somewhere. Let me see, might be higher than that. Yeah, it looks like $179. So it peaked at $179. It's at $98 today. $98. And see, when you put bonds into a fund, you've just created a stock. You've created a stock by doing that. If you had the 20-year bonds, they would be down similarly, but you can wait. Right now you'd have 27 years before they mature. No, I take that back. You'd have about 18, 19 years before they're going to mature. But, if you're young enough, you could wait that out and get the money back. Now, your choices would be to sell the bonds because they're down in price. Why do bonds drop when interest rates go up. Let me give you a really quick example. Let's say you've got a bond that's paying 4%. Okay, if you're paying 4% and then the rates go up to 5%, you're getting $40 for every $1,000. And I just have actually, I'm going to have to finish this after these commercial messages because we're coming up in a few seconds there. And this explanation is only going to take about 2 minutes. But anyway, why are bond prices dropping when interest rates go up? Right after these messages.
I got a story too good to hide.
And we're back. I've got just about 15 minutes, I think, or so, somewhere close to that. So if you have a question and you'd like to sit down and talk about a strategy, I know I've been talking about a lot of things and probably a lot of people's heads are spinning right now. I apologize for that. Unfortunately, financial topics can be incredibly complicated, and we're just scratching the surface, actually. So, my head is spinning about 2-3 times a week, and but I kind of like it. And if you have questions, you want to see what a simple plan might look like. And by the way, that's me. I don't want to leave out anything that's necessary, but I don't want to include anything that is unnecessary. And sometimes that can be a skill. But when you're thinking about how much are you going to need in retirement, a good rule is that 4% rule. I like that rule. By the way, that was someone who had a 50-50 portfolio, 50% stocks, 50% fixed income, which are bonds, annuities, that kind of thing. And again, the caller was calling in, was talking about the annuities. I was looking at one here. Let's say you're 66, you're going to be 67 next year. And I have to go back. I'm doing this on a website. It's through Nationwide. And if you'd like to get a link to that website so that you can play around with this yourself, feel free to call me. Let's see. And this is just based on a 66-year-old, going to be 67 next year, as you have to wait a year for the income to turn on. So on $100,000, you right now you'd get $6,558. Now that's on a website, by the way. So compliance department, this has been approved. And but yeah, just go to that website. And if you don't know where it is, just hit me up with an email. I'll send you the link. And it's really hard to get that kind of guaranteed income in any other source, even at 4%. It's still not the same. Now, it shouldn't really be compared directly to a CD or a bond. These are things that are they're actually fairly complicated. I like to focus on the things I think are most important. In this case, the thing that's most important is that the income is going to be $6,500, almost $6,600 a year, and once you turn it on, you don't have to worry about it. They just direct deposit it into your banking account. So that's pretty good. That's per $100,000. So that's pretty good. It's actually one of the better rates I've seen. The company's very highly rated, but it's just an option. And that's the other thing I think I like to think is a little bit different about the way we do things at my firm. We try to figure out, or with you, I try to figure out where you're coming from, what you'd actually like to see, what are the best ways of getting there, and then we'll show you 3 or 4 options, and you get to choose. And once we've got those in place, then we'll go ahead and make monitor those positions, make adjustments as necessary, and that's basically how it works. I hear so many financial programs, and I read so much stuff that gets into so much minutia that's really not that meaningful. The big things that you've got to worry about in retirement are, first of all, the amount of income you're going to be able to safely generate. That's the biggest thing that you're going to have to, that should be the biggest thing on your mind. How much income am I going to be able to generate? And will I be able to live off of that? And if the answer is yes, great. If you're one of those people that's done a great job at saving and investing, and you've got way more than you're going to spend, that's awesome. So you've got problems that other people dream about. Your problems are setting up trusts for your kids and trying to keep the tax man away from taking too big of a portion of what your returns might be. And that's another set of issues. And we'd be more than glad and willing to talk to you about those kinds of things as well. I have attorneys I've worked with over the years. I feel like they're very good. They're very competent. I feel like they're very fair on their pricing. And, we can, sometimes it's easier to talk to somebody who's not in that field than it is to talk to somebody who's an expert in that field, because they're used to talking to other experts, and it just might lose something in the communication. So, and again, that goes back to my roots, wanting to try to keep everything as simple as humanly possible. And oftentimes, it's not always that easy. Sometimes you're just in a situation where it is going to be complicated, especially today. People, been married more than once. They've got kids maybe from 2 different marriages. That's complicated, and that can get incredibly complicated. And to have somebody to bounce ideas off of that's familiar with what other people that are in the same situation have been doing and are doing, and then getting a recommendation, that can save you a lot of time, effort, and energy. And also, that's one of the other reasons I have to read a lot. But anyway, the investment management makes it look easy. I mean, and believe me, it's not. Just understanding what you have in your portfolio is rough. I mean, I know, because I've been doing this for so long. So many people have a lot of funds, and they're not even sure what the funds are holding. They couldn't really give you a good description on how they picked those stocks. And I think that's a little sad, because now you're in there and you're going 100% based on faith, which is fine. Okay. But I like my faith backed up with a little knowledge. The knowledge helps me keep the faith. That's a big deal, because I can't tell you how many times before I got to that point in my career where I was just questioning, what is going on? This is not what I expected. And it wasn't what I expected, because I didn't have enough experience. I didn't know what I didn't know. And the stuff that I did know, I didn't have enough time with, and hadn't really thought about it all that much so that it would have a big impact. Now, I am one of the, worrying about an investment performance is one of the last things I worry about in my own account. I know it's going to be there. I just don't know when. But I know it's going to be there. And I know that if I just keep going down that path, it's relatively simple. I think I have 4 or 5 funds that are extremely broadly diversified. And then I have, I think there are 7 funds that hone in on specific portions of specific industries. Now, those are a little bit more aggressive, because each fund in that group of funds that represent, right, I'll tell you, one of them's technology and the other is healthcare. So those groups of funds are honing in on a different area of that particular industry. And why did I do that? Well, because those 2 industries are actually growing faster than any other industries in the world. And remember, when at the beginning of the show I was talking about sales growth, or sales, you need sales and profit margin. The factor that has the largest impact over long time periods, historically, over performance, is sales growth. Now, I would think that would make total sense. If you're growing your sales, and you've had a really good run over the past 10 years, well, your business is going to be worth a whole lot more money than it was. I mean, think about it. If you were doing $1 billion, I can't even believe I have to use that big of of a description. But if you were doing $1 billion in sales 10 years ago, and here it is 10 years later, and now you're doing $5 billion, you're doing 5 times as much in sales, that should be worth around 5 times as much money, assuming that you were able to maintain your profit margins. And that's it. That's what everybody on Wall Street is trying to figure out. Which companies are going to be able to increase their sales into the future and maintain their profit margins. And they come up with all these estimates, and some of them are kind of wild. Next seminar I do, whenever I'm able to do seminar again, boy, can't wait to do that. But we'll talk about that in detail. And again, because I've been doing this for so long, I'll show you my shortcuts. You know, a lot of people get now be warned. When you know how to do this, what I'll show you, and if you want to come into the office, if you're a client and you want to see it one-on-one, no problem. You know, it takes less than an hour. It takes a lot more longer to practice it and use it than it does to learn how to do it. Okay. But once you learn how to do it, you're like, oh, now I see. And the next feeling is, wow, you got to have a lot of patience with that. Well, yep, that's true. You do have to have a lot of patience with any type of investing that you're doing. It's just the all those Facebook ads you see, these guys get rich quick on one stock. Yeah, if that were true, they wouldn't be selling that information for any amount of money. But and I'm really interested in trying to help people reach their own goals. You know, what are your goals? Are those goals realistic? How do you know if they're realistic? Sit down and talk to an advisor. You know, I think that's free. There's no cost to doing that. But so if I'm going to be realistic with my goals, then and I've got the money to put aside, that's basically setting up the plan is generally well, it can be complicated. Depends on your personality, actually. But I can show you ways of simplifying that and to where you can actually sleep at night. That's a big deal. And in fact, I think next week's program, that's what I'm going to focus on. The portfolios that allow you to sleep at night, but don't go to sleep on you. And yeah, that's an excellent idea. So tune in next week. We'll actually start looking at portfolios. I'll dig out some of the material on the reasons, those factors that we were talking about earlier. And now that I hear the music, that means my show's over. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.